Most people spend 30 or 40 years saving for retirement and building up their IRA or 401k, only to later realize that their IRA or 401k has become a tax trap, which has locked them into writing large checks to the IRS for the rest of their lives. Because the truth is, your retirement accounts aren't entirely yours. Not yet anyway. The IRS has a claim on every dollar sitting in your traditional IRA or 401k, and when you eventually pull that money out, you're going to pay tax on it. The problems usually come when you turn 73 and something called RMDs kick in. In plain English, RMDs, or required minimum distributions, are where the government forces you to withdraw certain amounts from your retirement account every single year, even if you don't need the income. Why do they do this? So they can tax you on your higher income, of course. In fact, the larger your nest egg, the larger the withdrawals you must make. And this means you can easily be dragged into higher tax brackets, which can have a nasty domino effect, like increased taxes on your Social Security or higher Medicare premiums. This can result in handing the government far more of your retirement income than you ever planned for, which means there's less income for you and your family to live off of and enjoy. But there's a strategy that smart retirees are quietly using right now to create tax-free retirement income and reduce what they'll owe later. It's called a Roth conversion. And today I want to show you how a Roth conversion works, walk you through how to avoid some of the common mistakes, and explain how some retirees are using it to potentially save hundreds of thousands of dollars in taxes over the course of their retirement. But before we dive in, I want to invite you to click the link below this video to schedule a free no-obligation consultation with me. During that call, we'll discuss your retirement goals and concerns. We're going to review your current risk for paying higher taxes, and I'll show you what options are available to you right now to save on your retirement taxes. Okay, so let's begin today by talking about a couple I recently spoke with. They were in their early 60s, and on paper they'd done everything right. They've saved consistently and built up several $100,000 across traditional IRAs and 401ks, so they look completely prepared. But when we sat down and mapped out their actual retirement income, Social Security, required minimum distributions, the whole picture, we discovered something that caught them off guard. Because of the size of their tax-deferred accounts, they were on track to land in a higher tax bracket in retirement than they were even during their working years. They were surprised, but I wasn't, because it's not unusual. It's actually becoming more common these days, and most people have no idea it's happening to them until it already has. And here's why. Retirement used to be simple. You worked, you retired, your income dropped, and so did your taxes. But today, many retirees are sitting on large tax-deferred accounts they've spent decades building, and nobody ever showed them how RMDs can affect the total amount of tax you pay. Waiting until you're 73 and RMDs begin before you start thinking about this can be a very expensive mistake. You need to be proactive and take action right now before RMDs ever become a problem. And this is where Roth conversions can change everything. The basic idea is straightforward. Traditional IRAs and 401ks are tax deferred. You got a deduction going in, but you pay tax on every dollar coming out. But you see, Roth conversion accounts are the opposite. You pay tax now, and qualified withdrawals later are completely tax-free. So if you strategically move money from your taxable accounts into tax-free accounts during those years when your income and your tax rate is lower, you could potentially reduce your total lifetime tax burden in a dramatic way. The mistake almost everyone makes is thinking Roth conversions are all or nothing. They assume you either convert everything all at once or you don't bother. But for most people, the smarter approach is gradual, intentional conversions done over several years, especially in the window between retirement and when RMDs begin at age 73. Because once RMDs kick in, the IRS starts dictating how much taxable income you must pull out each year, and you lose a lot of that flexibility. So it's important to act before that window closes. And if you like help with that, that's exactly what we do for our clients here at Coyote Financial. We'll take a look at your unique situation. We'll see if Roth conversions make sense for you. And if so, then we'll help you determine the optimal timing for these conversions to save you the most on your retirement taxes. And if you'd like to find out more about how we work and book a no-cost consultation, just click the link below this video to get started. All right, here's another angle most people never consider: what Roth conversions can do for your family. You see, large taxable IRAs passed down to children can create real tax problems for heirs, especially after recent rule changes that in many cases require inherited IRA funds to be withdrawn within 10 years. This can push your kids into higher tax brackets at the worst possible time in their lives. You see, Roth money, however, is generally far more tax efficient to inherit. So, a well structured conversion strategy may not only protect your income in retirement, it can also protect your family's financial position after you're gone. Now, all that said, I want to be straight with you. Converting all your retirement savings into a Roth IRA is not the right move for everyone. Good retirement planning isn't about putting all your money into one vehicle, it's about building a balanced structure. The strongest plans I've seen combine multiple buckets: some taxable, some tax deferred, some tax free, all of them working together to give you flexibility regardless of what tax rates or markets are doing. For many retirees, having a portion of their savings positioned for tax free income later creates enormous peace of mind. Why? Because having pools of tax free money in retirement to draw on when you want gives you more options for staying in lower tax brackets, especially during periods of market volatility, rising inflation, or unexpected healthcare costs. Now you get to choose where your income comes from, which matters more than most people realize. I found that retirees spend enormous amounts of energy thinking about how to grow their money and almost no time thinking about how to withdraw it efficiently. Distribution planning is where retirement plans quietly either hold up or fall apart. One more thing worth noting is timing. Today's tax rates, historically speaking, are relatively low. That's probably not going to last forever because tax laws change, and opportunities that exist today may not even exist in 5 years from now, exposing you to what I call legislative risk. Of course, that's not a reason to panic or rush into anything, but it is a reason to plan carefully and deliberately with a clear picture of your current bracket, your protected future income, and your full retirement timeline. The big takeaway is this: retirement today is not just about accumulation, it's about distribution. And the retirees who struggle the most aren't always the ones who save the least. Sometimes they're the ones who simply never planned for how taxes would affect their withdrawals. The ones who feel most confident tend to have flexibility, a protected income, and multiple tax treatments working in their favor. This is also exactly why do-it-yourself retirement planning gets risky when taxes are involved. So listen, one oversized Roth conversion in the wrong year can push you into a higher tax bracket unnecessarily and have potentially devastating effects on your Social Security taxes and your Medicare premiums. And the difference between a good strategy and a reactive one can be worth a significant amount of money over the course of a 20 or 30-year retirement. So if you're between 50 and 75 and you want to understand how Roth conversions and tax planning might apply to your specific situation, click the link below to schedule a call. We'll take a real look at where you are today, identify any risks hidden in your current plan, and explore opportunities to create more tax-free income going forward. There's no pressure on this call, no obligation to move forward, just an honest conversation built around your goals and your retirement. Thanks for watching today, and I hope this video has been useful to you. Take care.